Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Will.
And I'm Brian.
And I'm Mortgage Mike.
So today, guys, we're going to talk about solutions in the market right up front. We're going to talk to people today about scenarios that are working in the market right now, despite all the headwinds and other things that are happening in real estate and mortgage. I want to talk about some solutions right up front. Then we're going to get into a new law that just passed about ADUs that can now be sold separately in California. That just came out last week, and now we're going to talk about it so people know what's going on. And then in this brutal housing market, you'll need to make $115,000 to buy the typical U.S. home. Ouch. And new listing data is unfazed by 8% mortgage rate. So
nice. Well, it sounds like, we got a lot to cover here.
We got a full show today, guys. We're going to get right to it. Let's start with the scenarios of how people are winning in the market right now. So I'm going to pass to you, Brian. Let's start talking about some of these that you've been uncovering.
Yeah, of course. So we had a client tap into their equity this past year. And basically what I wanted to highlight of this success story was that our clients were battling trying to get approved to get cash out for doing repairs around the house and consolidating, over $80,000 worth of debt. So a little background story on their situation. They had a sub 580 credit score, and no lender wanted to touch their file. They went through multiple people. They got dragged around, told them, yeah, we could do it. Yeah, we could work on it. Yeah, we could definitely do it, but never fully actually gave them a road plan, a roadmap, or even just steps on what they needed to do to get their credit up.
And I'm sorry, I'm going to stop you right there, but a lot of times when they get dragged around like that, I always notice the common denominator is credit scores have the tendency to even fall even further.
Yeah.
Because they're kind of, they're thinking they're going to have this lifeline, and then all of a sudden it's like, well, I can't make that month payment. The loan officer didn't tell me anything, and next thing you know, it went probably from a 680 kind of dropping all the way to that. So
and so what I saw was an opportunity to see what their actually file was looking like. B, show that I care, because obviously they were a referral from a friend, and wanted to really unpack what was happening, why it is that nobody wanted to work with them, and then give them actual facts or a roadmap and truth about what they need to do. So after working with them and going over their credit, we were able to analyze it, go over some of the debts that they had. They did have some money in the bank, but not all the money to basically get them out of the situation that we're at. So what we did is we analyzed the credit, told them, hey, pay this down to this amount. We did a credit simulation, which basically allows us to go into your credit report, analyze what you have, see what needs to be paid down in order to boost your scores up a little. So we were able to do that. We did an analysis on it. We boosted their credit to the minimum of a 580. So for those who don't know, you need a 580 minimum credit score to do an FHA loan. Now, that's not the only thing you need. There's going to be other compensating factors that come along with that, but 580 for the score is what would do it. So after we did that, that was probably like a 2 to 3 month process of us, working, getting the credit up, paying their stuff down. Come down the line, they gave me a call. Hey, we did it. Brian, our credit went up. Like, we followed your instructions and it actually worked. I'm at a 580, like this, and that. And I was like, oh, great. Like, awesome. Like, this is why we do this. And so to speed it up, we went through with the cash out refinance. We went into underwriting. Everything passed by. We ran DU, even at a 580 with multiple missed payments, dragging late payments, still got it through. And they were able to successfully take out $80,000 worth of cash from their equity to be able to pay off those debts.
Got it. And when you're talking about late payments, Brian, are we talking about mortgage rates?
No, credit cards, loans, car payments, and they inclusively had a repo on their case as well. So it wasn't the prettiest file to work with.
So,
sounds like it.
So that late payment, was that a condition? Like, is that like a funding condition? So that, obviously it was a late payment, right? So would that would be required to be paid off in order to do this, or how'd that work?
Did need to be paid off at zero to be able to basically get it to go through. But even with some of their lates, the system DU took it as it was. So as long as we were able to get the desktop underwrite, the system took it. Submitted it into underwriting. They didn't ask for anything on the lates, just on the things that needed to be paid off in order for DU to take it, which was great. The biggest thing that I wanted to get out of this was, the clients saw the opportunity, and they also saw what it would cost for them not to do it and to do it. For them, it did cost a little bit, having to bring the rate down, the closing costs that they'd incurred, but who's going to give them $80,000 to basically wipe off their debt? And at their credit profile, their payment did go up significantly, maybe like $700 to $1,000, but then they did free up $2,000 in cash that they were paying debts monthly.
So they're saving $1,000 from
So
that.
essentially, it was a win. They're saving money rather than
That's what I
quote
noticed
unquote.
in your show notes. You're saying they had $2,000 of monthly recurring payments, and so even though the total mortgage expense went up by $700, their out of pocket shifted by $1,300 in their favor.
Yep.
It's a huge difference.
That's pretty big. That's a big deal. $1,300. That's a lot. That's a lot.
Believe me, it wasn't an easy file, and that's why it took some time to work with them, really get get all the specifics down, and let them know, like, hey, if you actually do this, make these steps, you're going to be able to get the cash. And fast forward, they're still waiting for us to refinance them again to get them that PMI out.
Just real quick, like just do some fast math real quick. Like $1,300 a month is some significant savings, but you annualize that's $15,600 of saving every year. That's crazy.
And it doesn't stop there, because remember, all the interest that you're paying into your mortgage is also a tax write-off.
Mm-hmm.
Whereas if you have that credit card debt or car debt, etc., you don't get to write it off. Or depending if you're a business owner, it's a different story. But in this case, we'll keep it that it's just a regular consumer. They're paying credit card debt, their car payment, and here's the thing: some things might have happened with that family.
Oh yeah, definitely.
They needed this when they got into those debts. Probably their job was okay. They got a pay increase, and then next thing you know, maybe wife lost her job, husband took some hour pay cut. We don't know what happened. But all I know is that there was a solution in place for them. And when you pay such a large debt like that, I mean, $80,000.
It's a lot.
That's
right.
A lot.
Yeah.
It's just like this burden off your back, and it's like now you can get refocused and you can go and do the other things that you need to do.
And to that point, what would it feel like if someone gives you $1,300 back of your income every month? Like, hey, you just made yourself a $1,300 back recovery every single month. I'd be super happy with that.
And it was that switch of mentality where it's letting them know, like, hey, you're paying more over here, but you're also freeing it up over here.
Correct.
Yeah.
And when you're able to see that and they're able to understand it, they look at it like, wow, why didn't I do this before? Why didn't I take this lifeline that I've had in my house for how long?
Well, what was the interest rate prior to?
3.625.
And that's the thing a lot of times, you know what I mean? A lot of times, hey, I got a 3.6%. I don't want to lose that. But there's a bigger picture here. And you just presented that. And I'm sure if you call them right now, they'll probably be in tears.
I mean, I'm not going to say their name, but I still speak to them very regularly. Good. They're great family friends, and they're very thankful. And I'm actually very thankful to them that they allowed me to help them out, and we were able to make it happen.
Yeah.
Awesome. On
Good deed done.
So on the flip side of that, we were also able to help a client with a HELOC, a home equity line of credit. And this is a little bit different than a cash out refinance where you're not paying off the current mortgage and then, taking out whatever it is that you want to take out from your equity. This client didn't want to go above a $3,000 payment, and they had a $2,067 monthly payment. And what we did is I showed them two scenarios: the refinance versus the 5-day HELOC. They saw the refinance payment went up to $4,200. They're like, that doesn't make sense for me. So then I said, let's try this program. It's a 5-day HELOC. Essentially, it's like a credit card, 15-minute application. You go through it, you put in your house information, you basically verify all your income and stuff, and then from there it lets you know the value of your house, how much equity you have, how much you're able to pull based on your income. And if you like what you see, you literally click, and you're able to then go to the next step, which is basically, hey, this is your final offer. If you like what you see, we can set up the time to sign with the notary. Their story, what they wanted to do is basically get 30 to 40K out to do home repairs and pay off some debt as well. Gotcha. So they were able to get that money. Their payment only went up by $750, which kept them under that $3,000 mark. Nice. And they were able to secure that equity. So for them, it made more sense to do the HELOC route, still secure their funds of their equity, but not do the refinance and basically do the whole debt all over again. Which,
how much was HELOC? Like, how much funds did they take out on that?
So they took out a total of $55,000.
Okay,
so a little bit more than what she wanted, and it was because she said, "Hey, I thought the payments were going to be higher," and then she's like, "No, don't adjust it to the 30, 40K. I can do this." She actually got more than what she thought, and it worked out for her because now she has a little bit more cash to go into the winter.
So basically, as I'm hearing you retell this story, I hear that the client had a threshold of what they're willing to pay every single month. then what they initially thought they were going to get was less than what they could get because that threshold was not exceeded by the amount of monthly payment.
Exactly.
That's dope.
Yeah.
That's really cool. And
Yeah.
so the whole 5-day HELOC, the client expectations requirements are pretty low. Sounds like you're saying,
Super easy.
here's the offer, click this, push that, whatever. So is there a credit requirement for
So
this?
yeah,
Talk to me
there's
about that a little bit.
620 credit requirement, and then depending on your LTV, that's going to allow you to pull different amounts of money. So that's case specific to your mortgage and how much you owe. But basically, as long as you have a 620 credit, equity in your house, everything's going to be virtually verified. So as long as you submit your application, they're going to ask for your bank statements, your pay portal if you have one, but everything gets done through a third-party verification. So there's no actual documents that you have to submit unless they really do need to verify them. Once that process is done, that gets done under 1 day because you're going to get funded within those 5 days.
Yeah.
So that process is very quickly. It's like I said, you submit, you click, they verify. They actually go through Plaid, a really good third-party authorization that a lot of big businesses use. So that's what they basically use. They utilize all virtual information, and if basically what you put on your pre-application matches what is verified, then the offer stays virtually the same.
Oh, that's great.
Brian, and did I hear that correctly? You said it was a 5-minute application?
It feels like a 5-minute application. If you have all your information, literally my client, I sent it to her maybe like at 7:10 and she was done by like 7:20.
Wow. So it's that easy.
It's super easy. It's like honestly going online and typing Amazon information.
Click, easy.
It's literally how it feels. Click,
It
fine.
almost sounds like a no-brainer for people who need cash without using their equity.
Here's my question with that. And considering that they had a 3.625 on their first, they didn't have to touch that. They got a second line, which is a second lien on your property, right? What kind of interest rate did they have there?
So very good question. Just like a credit card, it's going to go based off your credit, right?
Okay.
So the higher the credit, the lower the rate. The lower the credit, the higher the rate. For them, they didn't have, the best credit. So they got roughly a 13% rate.
Okay.
But for them, like I said, the monthly payment outweighed the rate. So for them, it was just a no-brainer.
Well, then it also works out because if they're paying credit card debt in the next 3-4 months, because it usually takes the credit bureaus, anywhere from 60 to 120 days to reflect all that stuff. At least we could expect within 3 months, 6 months, their credit's going to increase.
Exactly.
And when rates start going down, they're in a better position now to take advantage of all that. But if we're considering a 13%, Andy, and a 3.625, there's always what's considered a blended rate. And you're the mathematician here. I don't have my calculator.
There's a missing component, which is we don't know the amount of the first balance. So whatever the first loan balance is going to be a big part of this.
The first balance was around 390.
390.
Okay, so at 390, so they're borrowing basically 15% of the total, which is the 55,000. So that 13% only represents 15% of their total loan balance. This is just off the cuff. And all you people in the comments box, easy. I don't have a calculator in front of me, but that's about where we're at.
Even if I had a calculator.
That's about where we're at. It represents about 15% of that. So the blended rate is going to be significantly on the low side, somewhere in the 4s probably.
Yeah, I'm going to even take just kind of throw one out there. I would say it's going to be in the mid 5s, even 6. But that's still good. Your blended rate is still,
combined basically with your value that you have on your current HELOC and the value in your current mortgage, combining them is going to give you the blended rate of what you paid on both of them.
Yeah, that's right.
Wow, I just learned something new, guys.
That's a really good, and it's proportionate to the amount of the amount of the first compared to the amount of the second. So, but again, this is a quick way to get $55,000. So if you're going to do these repairs you're talking about, pay off some debt. Because also there's a swing. If they're paying off some of the debt, that's again an adjustment in the out-of-pocket expense that they're having every single month, but also getting the advantage of not having to pay out of pocket for all the increases or the improvements that they were going to make.
Exactly.
So that's awesome. So if people that are watching this want this, they just got to call you guys or email you or what?
Just send us an email, shout us out on a
Should they say 5 day? I need the 5-day HELOC.
Just put 5-day HELOC in the comments and we'll reach out to you. No, for those that get this on the weekly newsletter, make sure you just reply back to us and get more information because that's the easiest way for us to get in contact with you guys. So if anybody wants information on how to utilize the 5-day HELOC or even see what a scenario for a cash out, definitely reply back and we'll be glad to do that for you guys.
Yeah. Awesome. And here's the other thing, because we've been getting a lot of people following us now and subscribing to our channel. If you're in a different state, just give us a call. We'll be more than happy to guide you. If you have somebody there already, just ask your current lender.
Yeah.
course.
That's awesome.
Make life simple.
That was great, guys. I love starting off with the solutions. That was an awesome transition into another solution, which is ADUs can now be sold separately in California. Assembly Bill 1033 allows accessory dwelling units, or ADUs, to be sold separately from the homes they are associated with, in effect creating 2 or 3 unit condominiums. This was really exciting news for me. I don't know about you guys, but what was your initial reaction
What
when
do
you
you
saw
mean?
this?
I love ADUs. You know, I'm all about ADUs.
You're the ADU guy.
This is like the new gold rush, right? So this is just phenomenal, especially because they're not going to consider, there's currently what's called a deed restriction, and it has to be an owner-occupied property for you to do ADUs. Right, in some areas now it's like the municipalities and the cities and counties don't. You could just tell them the rules are changed. So now it's allowing you to do more, and it's gonna hopefully encourage more homeowners to, now I don't have a deed restriction, and now I can pursue this. Because a lot of times what would happen if you have a deed restriction there, you're selling the property and you have to inform the new buyer that there's a deed restriction. You know, so if they bring somebody in, it's not like they can just rent that out, Airbnb, etc. So there's certain restrictions. Now it's kind of, hey, free game. We're able to do certain things that we couldn't do before. So it's a really good news, exciting that, you know, some of our people are fighting for us and just making it where we have more homes available for us.
And we talked about this in the beginning part of the year. We said you're going to start seeing a lot of creative solutions. Some of them will be from the government. Some of them will be from local municipalities. Some of them will be from the industry as people try to figure out how we do this affordability thing. How do we increase home ownership and that whole thing? You know, and I was honestly, I was so surprised by this number when I read this article that statewide, California, statewide, there were 44,532 ADU building permits issued in a period from 2020 to 2022. 44,532 ADU permits were issued.
I mean, Andy,
that's
you guys,
crazy.
This is the gold rush. You know, if people aren't taking advantage of this, I don't know what else you need for you to take advantage of utilizing your home. You know, to a lot of people are like, well, I just don't want to open up my doors to just you know, to somebody else. It's like, well,
now you can send credit.
And
well,
take a look at who you're bringing in.
What if only 25% of those end up being sold? That's 11,000 new units. Like that, we keep talking about inventory and shortages and all this, and the supply and the scarcity is driving costs and all this. Well, if all of a sudden 11,000 new homes show up over the course of the next year or two, that completely helps some of the shortage we're having. And I'm using a 25% number, let's say conservatively. I don't know if it will be or not, but you know, just for conversation's sake, that could be a lot of new inventory hitting the market.
Actually, I have a question for this guy right here.
Whoa.
He has an ADU on his house. Early,
Big ADU guy.
Earlier, me and him, I was telling him, I was like, well, Will, if I had an ADU on my house like you do, I wouldn't want some random person living there. And then that's when he let me know, you know, you run credit and find a qualified applicant. But my question
is already a random person.
All right. But, you know, we talked about this solves almost the affordable housing crisis or whatever. But, Will, if you were to sell that ADU on your property, what would you want to sell it at?
Yeah, it all depends what the market is doing at that point in time, right?
Right now.
So, like, if we sit in there, I mean, I don't even know what the square footage is on it, but I'm just gonna take a guess here. I'm just gonna say it's about 700 square foot. I'm gonna analyze what the square footage is right now selling for a regular home, and then I'm gonna just put that there. So I'm gonna sell.
Okay.
So let's just say it's 500. Andy, mathematician.
So
well, 500 times 7.
350,000.
There you go. That's what I would sell it. 350,000 for that.
I mean, it is a nice ADU.
So one of the things I see an opportunity here is the fact that an ADU is probably going to get built a lot faster than a new neighborhood, right?
Yeah.
So there's going to be a lot more houses, or quote unquote casitas, condos, whatever you want to call it, in the next year than builders building more houses. So in an immediate solution, this is a great thing that the government and everybody in housing commission did, because of the fact that it opens up more houses sooner, which is our problem right now that we're dealing with.
So it's not this, but you know what this is making me think of? It's like the tiny home revolution. It's like, oh, I'm going to go buy a little tiny home. It's going to be 50 grand or 100 grand. I'm just going to have this little tiny home. I mean, it's essentially the same, but it's on this shared lot that, the main primary house homeowner has this extra place on their lot.
I mean, guys, how many times have we seen empty lots?
Oh, I drive by them all the time.
I drove past
How
two
much
today.
more is this going to encourage people to utilize those empty lots and even put those smaller homes? Because now the government's encouraging you to do these things.
Well, guys,
where they're going to simplify that process.
Well, one of the big complaints we hear, especially at these networking events, is, the permits take so long. And I know you just said we'll probably see ADUs be built sooner, but I mean, do you think this is going to overcome the obstacle of, getting the permit and all that? Do you think that's going to
make
speed
it
it
a
up?
lot more congested in the beginning stages, but after a while they're going to have to do some sort of how to say crowd control or quality control to be able to intake that much business.
I think it really depends on how quickly people move on this new rule. So if they choose to move on this new rule, then you're going to see a heavy influx. A lot of people are going to rush the gate. But I will also say, I literally had this conversation before the show today with my financial planner. We were talking about how all this ADU and like freeing up these resources. There's a new psychology and mentality of homeowners who are looking for places that they could do this on, and he did not even know yet that the county of San Diego has pre-approved plans that fast track your permitting process.
Yes.
So to your question, if you're going to make your own stylistic changes, you have to get in the regular line. But if you use the pre-approved permits, you're getting fast tracked to your permit process.
And I think that might be a huge area of speeding it up because of the fact that it's hey, you could do a custom made, or you could already do streamlined process that already has this, and basically going to get you the same thing.
Well, guess what, guys? There's another bill that was passed for that.
Oh God, I love it.
And that's AB 1332.
Yes.
What is that?
What it is if I already have the certain plans, then I can just present those instead of representing to the builder and saying, hey, you have to go through the whole approval process. If I already have plans that are approved for a project that I've done, and I have a similar project that I'm going to do elsewhere, well, it's already there.
So essentially what you're saying is hey, I just built an ADU in my backyard. I already have approved plans. And I also have another house that I'm planning on doing it. Can I just take my plans and just walk them over?
Right.
Copy
because
and
it's
paste
the
it.
same thing.
It's the same thing.
It's a templated ADU.
Yeah,
exactly.
I mean, if it's in the same municipality, they've already seen it.
Even better.
They'd already approved it.
That makes a lot of sense.
So those are things that they tend to work to facilitate the process and not just clutter everything.
See, I'm sure
bottleneck.
they're smart enough to
So
get
if someone chooses one of these template ADUs almost, I mean, typically we hear 12 to 14 months for permits. No, sorry, that's the total time.
Yeah,
but it's a few months. I mean, how much quicker do you think it'd be with?
Well, it's part of its volume still. You still have to be in line. So how many people are in front of you? I'm just saying that there's a difference between going through the regular line of a custom permitting process of rebuild versus the pre-approved template. So it could be a matter of a couple weeks or a couple months still. It just depends on how many they got to approve. That's really the deal. It's a volume thing.
Yeah, it's going to cut your time at least anywhere from 3 to 5 months.
Oh, for sure.
Just for that, And here's what people don't understand a lot of times. And we're talking about investors. We're talking about homeowners. They're going through the plans. A lot of times we go to get the financing. And what's been happening is, okay, well, we already have the financing. Here you go. But your project isn't permitted yet.
Right.
So now you start making payments on some borrowed money that you haven't even started the work on.
Yeah.
So those are all the things that we have to consider in place to make sure that everything's going according to plan without incurring certain expenses at the moment in time when your project's not being conducted.
And those are the little things that people don't tell you until you're fully in there, and all of a sudden, damn, turns out I got to fork out another $20K.
So would you actually tell someone to get the permits first before the financing, or?
That's a great question. Absolutely.
If they can, yes. But the permits have a cost too. Yeah. So they could run anywhere from a couple thousand to a couple tens of thousands, depending on what you're building. But that process does take time to get them, and then you have to be able to pay for it.
Yeah, you want to get a feasibility budget, know what your costs are going to be, because they're going to be soft costs that you're going to incur, like your permits, your architect, stuff like that. You want to understand that stuff. So the first thing is see what your budget is. And then you get an architect that's going to help you, hey, this is what I think I want to do on my property. And obviously, if you get a good architect, they're going to probably change your mind because they see the property in a different way than you will. And they'll maximize your space, etc.
Yeah. It's like being a head coach. You need an offensive coordinator, defensive coordinator.
That's right.
Yeah.
Hey guys, when they said in the article, lenders can now include rental income from ADUs when assessing mortgage applications, do you think that meant for houses already with an ADU or ones that you plan on building the ADU on?
It works both ways.
Yeah.
Oh, okay. That's good to know.
It's going to work both ways, so which is great.
That's
encouraging
awesome,
also.
Yeah, so FHA mortgages for new construction.
Yeah.
So that means they're not constructed yet.
There's also something I saw right there that additionally, the policy sets specific guidelines for appraisers to introduce ADUs to FHA. So I feel that's going to also give appraisers some sort of information or some sort of class schooling to know how to, appraise ADUs now that they're, going to be able to be sold as, single dwelling, triple dwelling, whatever, multiple condos.
just like our loan application changed a few years ago, their actual report is going to change now because now they have to consider these things. I think they're going to start implementing more also as far as the solar panels, right?
Yep.
They're going to, or energy efficient, like even if you did your lawn work and stuff like that, we're starting to see that. Like I start going to neighbors' house, I'm like, man, why is their grass so damn green? Like it's green and mine looks yellow. Like what's happening here, right? But then you get close, it's artificial. So it's like, okay, I get it. But it conserves water.
It was like they accidentally installed yellow artificial grass in my house.
In my house, right? Why mine? Well, but so they have those things, and now with the ADUs, they'll have to consider that because appraisers will also have to be encouraged to look at what the future rents are going to be for that space. So a lot of things are changing.
Yeah, and that's going to be interesting seeing how the rents get measured assessed. because of single family ADU here, no ADU in let's say a mile. Like it's going to be interesting.
Well, and this I think kind of this envelops, this wraps up this concept of inventory being an issue. We see a lot of people migrating out of California or young people that have to go live somewhere else because they can't afford to buy here. This will help alleviate some of that. It might bring some new inventory. It gives sellers the option to sell it independently, but this also achieves this other goal, which is bolstering housing affordability, but increasing home ownership opportunities. This is always the goal of every administration, is to increase the amount of the percentage of Americans that are homeowners. We talked about this a couple shows ago. Every administration cares about getting more Americans into homes. And so this, even in a weird way and in a different micro home kind of way, helps achieve that too. So you're going to see probably either a leveling off instead of a decline or a leveling off and an increase of the percentage of home ownership over the next 3 to 5 years.
Meanwhile, they kind of get it up, ramped up.
And this is what they say too, that in our country, our population doubles every 50 years. So, if we're really looking at it and we're not building homes fast enough.
When was the last time we built so much? And then, from there, how many have we doubled?
We already know. We've been talking this in other episodes. Contractors are not building homes fast enough. And they're doing it purposely, right? Because if they put too many properties out there, are they going to sell for top dollar?
No. Cost competition, no.
Well, it's costing them more to build. And then if they're sitting there, now they're losing money by building houses. It's like, I'd rather not build than not lose.
One point that I like to bring out, when there's an HOA, like similar I have where I did actually construct my ADU, which my mother-in-law lives in, a lot of people have this misconception that if there's an HOA, you can't build it. No, it's a law. So because there's a law in place, you are able to construct. They cannot have you go against the law. There will be some restrictions that the HOA can, tell you, like, for instance, hey, you got to keep the aesthetic the same. So if there's a car garage, like, some people convert their 2-car garage into it, at least keep the aesthetic so that it conforms to the community, in the neighborhood. So maybe you leave the garage door, which is not bad. So little things like that, but don't be afraid of HOAs, is what I'm saying.
Nice.
All right, guys, let's move on. We're going to now tackle a little bit more of a difficult topic. This is in this brutal housing market. Let me start that again. Wow. In this brutal housing market, you'll need to make $115,000 to buy the typical U.S. home. It's almost 3 times more than what the standard American household makes. We're talking about averages. Again, disclaimer at the front end of this segment, this is not in all places and not for all people. These are the law of averages, and you guys know what they say about the law of averages. The guy who tried to cross the river that was an average of 4 feet deep drowned.
Dang it.
Law of averages. You have to remember there's the higher end and lower.
So for me, what stuck out right off the bat is you need 15% more income from last year, but then 50% more than early 2022. But then here's the kicker. But wages only increased 5%.
What?
In that same time frame.
Oh, what?
Yeah. So
wait. McDonald's increased it to $20 now an hour.
So we had shared this in our little group chat. I think maybe a couple weeks ago. I was showing the time evolution of that chart of affordability, house price connected to income, and that the disparity, it just keeps growing larger and larger, and the cost goes up, and the income kind of like piddles along at the bottom there. And that's kind of what this is getting to. This is the kind of the whole point. We have a couple functions or force functions here. Number one, The median house price is significantly higher now than it was just 2 years ago. You have some wages keeping pace, and a lot of them not.
Yeah.
And again, wages is even an arguable term because you have commission-based wages, you have partial commission, you have salary, you have all sorts of stuff. But the fact that $115,000 is like this now average, I mean, that's for most people 2 incomes or 2.5, 3 incomes in some cases to meet that threshold. And now we're not just talking about like San Diego, San Francisco, LA, New York, Miami, Denver, Dallas. Like, we're talking about nationwide. I've never seen this before.
No.
I remember making $100K, 6 figures used to be like, and now that's the bare entry minimum.
Yeah, that's like my housing and grocery bill for my big ass house.
Basically.
I mean, guys, it's brutal. I mentioned that I approved a client like last week on our other episode, and they make 140 and change, and the max approval was 650.
Yeah.
Jesus
Right.
Christ.
FHA.
Right.
What was the rate on that?
7.375 is what we put at.
Right.
Did they have a lot of other debt, or what was going
Well,
on?
no, the thing is FHA
46
doesn't
over 51,
Yeah.
so it's not a lot.
You're
It wasn't a
46,
lot.
you're capped on the front end.
Correct.
Jeez Louise.
But then goes to show you 46% is still only 650. That's ridiculous.
It's
Well, and this kind of goes back to the point of like the
Yeah.
price and the function of the income is a real problem for people when it comes to affordability. I mean,
Yeah.
in the same time when O'Brien's talking about since the pandemic 2 years ago and all these numbers, you had the median price for U.S. home in August was $420, and then you had 2 years ago it was $260.
Interesting.
So it's more than a 50% increase in a 24-month window.
Crazy.
Like we've never seen that before.
Yeah.
So this is untenable on most services. This is why you're going to see more creativity happen.
Yeah.
Like we talked about in our last segment, discussing the ADUs and being able to sell those individually. They're going to have they meaning builders and finance companies and banks and the government and what they're going to have to come up with a solution for this because for most people this will just they'll be forced renters forever. But that will go up for them over the course of time too.
You're saying that they have to find a solution. They're trying to find a solution, and it just keeps backfiring. It's like, here we go. We just don't know what they have to do. I don't think they know what they need to do.
So let's try this way. Nope.
No.
Let's try this way. Nope. Let's try this way. Nope either.
I do think the new law in California that passed, allowing ADUs to be sold independently, will help some of that. Now, that's not so many volume of unit sales that it's going to make a dent in this number of median price. Because again, even in California, some of these ADUs might sell for $250,000, $350,000.
That's SFR somewhere else.
That's kind of close to $420. We're not talking $90,000.
Yeah.
But again, this is where maybe this is like the barometer for most people to go, okay, this is where I have to get. So maybe what we should be talking about with people is that this is the milestone to shoot for as your like threshold for entry is 115,000 or maybe 150,000 here in San Diego. Start there. Because I know around us here in the East Lake area in Chula Vista, you'll see some condos. Maybe it's a 1-bedroom, 1 bath or 2-bedroom, 1.5 bath. You'll still get that in that 600, maybe 650 range.
It's just still crazy.
But here's the thing. Yeah. It's very competitive.
Yeah. Oh, yeah.
So it's not just that, there's a home for $650, but you're 1 of 10 people still, even in this market.
Yeah.
So number one, I want people to know, okay, have a target and work towards it. Number 2, pay down your debt. Number 3, understand that when you come in the market, like you come to compete. Like you're gonna have to go hard at what you're trying to get because the house might be in that range and that threshold that you can afford, but you're gonna have to go get it.
Yeah. I mean, and come with 3 other co-borrowers.
Three.
And keep 2 in your back pocket just in case.
Because I remember back in the day, and I'm talking back in the day. I'm talking a few years ago. It's like 80,000. We're like, that's great income. All right, we could get you there. 600,000,
you'll
not
be
a
good.
problem.
Condo.
Okay, good. Now we're saying like 150. Ooh,
You got anyone else?
Like those are the conversations we're having. I mean, you're talking about 420 with 115,000. That's crazy.
That's really like a quarter of your income.
And then here it is, guys. So let's just say like next month the rates go down. Right? Let's just go down and they're in the 4s. What do you think is going to happen now?
People swarm the market because of
The
the
prices
same.
are going
It's
to
like
go up. I literally just wrote that down.
Literally.
We have to talk about that because people don't know this is happening. Or they don't know that this is a function that would happen.
Yeah.
Okay, so let's talk about it right now. So Memo's point is that if the rate turns around and let's say the Fed eases up on their policy and
that's what we want,
mortgage
right?
market, the mortgage market starts easing on price. Let's say we're not at 8 anymore, we're at 7.5, and then we're at 7, then we're at 6.5, then we're at 6. What do you think is going to start happening to price? Price is going to go back up.
Prices.
So we might be opening up some affordability, but prices are going to go back up. They're going to reinflate because we go, it's not 8 anymore, it's 6. Now I can't afford 700, not 675. Bid it up. Go write that offer for $25,000 more.
I think this is a hard pill for a lot of people to swallow, but I think we want rates to go down, but we don't. If they go down, we're not going to get out of the same problem, and we just go back to it. And even worse, because now more people come in, the prices don't come down; they go even higher. So, I mean, as much as we would want rates to come down,
everything has a trickle down.
Everything
effect.
has an effect that could be positive, negative, depending on how you spin it. I just, for me, still think it's ridiculous that the wages and income isn't matching or isn't going up for that matter, and there's not really much you can do about that.
Well, your timing and all this was perfect because it's almost like we've known each other do this for 18 years. I wanted to just to make a pit stop real quick with the Fannie Mae Senior Vice President and Chief Economist, Doug Duncan. Remember Uncle Doug? Uncle Doug. He's saying that he doesn't anticipate affordability issues will ease in 2024. Yay, thanks for the good news. Quote,
optimistic.
Quote, we expect a higher mortgage rate environment to continue to dampen housing activity and further complicate housing affordability into 2024. So this problem doesn't look like it's going away. Now, it's one man's opinion. That's fine. We're 4 other people here. But, the math is the math at the end. And to your point, Brian, like people are going to need to make more money. That is part of it. They're going to decrease their debt. They're going to increase their credit score. So going back to if you missed it in the first part of this episode, we talked a lot about solutions and how people are winning in the market right now. And Brian talked a lot about credit scores. And he talked about like being focused on your finances, creating a budget, working at it, setting a goal, getting a target for yourself, and then taking appropriate actions, even if they look weird on paper, but they're right for your life. That client example you gave me of making $1,300 back a month, that's over $15,000 a year that they're putting back in their pocket.
Yeah.
That's wise.
The best solution, build a budget. If you're thinking, a lot of people are already on Amazon and they're on auto pay, right? You just order and it comes.
Yeah.
Yes.
The best thing to do, if you have those type of accounts, just remove your credit card. Just go in there, take that credit card out. Make it to where every time you purchase something, you have to go in there and re-input your credit card information so that you can make that purchase.
Just stop it.
I bet you get lazy and don't want to put it in.
I haven't.
That's exactly it. So I was gonna go. I go, Tanya, can you go? Because we started like budgeting. We had to. You have to. Let's be realistic. We're all hurting. Yeah. Okay. And we all have to budget. Because there's a future. Now I'm a grandpa and everything. I want to see a better, brighter future for my granddaughter. Yeah. So what I tell her, honey, hey, I saw Amazon always bringing in the box every day. And I know that because my Vivint, my little thing would tell me, bing, bing, there it is, your delivery's there. But, so I asked her, she goes, I have to put that, can you get my credit card from my bank? Guess what I did not do?
I don't want to go get it.
I was doing something else. I didn't do it. Guess not what I did.
Didn't buy it.
Save money there.
Yeah.
I didn't buy it. Yeah. So I say if you have it like that, remove that credit card from there.
Like,
and I'm
share,
telling you, you're going to save
follow.
thousands of dollars.
I got a health analogy.
Share, and follow for more money tips.
I got a health analogy for you, Mikey. It's like if I need to keep donuts out of my life, I got to keep them out of my house. I can't just put them off the counter into the pantry. There's a real one for you.
Yeah.
You're welcome, Jen. All right, guys. Let's close the show out.
Go.
We got last article. New listings data unfazed by 8% mortgage rates. In a crazy year for housing, one data line has been steady, and it is that we have an inventory problem.
Yeah.
So
listen, again, it depends where you are.
Yeah.
Correct.
You mentioned Redondo Beach.
Yes.
They're telling you homes are staying in the market for how long?
60 to 100 days. Thank you so much for commenting on our last video. We had someone who said, I live in Redondo, and we have a 60 to 100 day days on market. And I'm like, that's crazy.
Yeah. Again, it just depends where you're at. I get all the data. I get everything that's going, but everything's
micro markets.
It's not state. Yeah, there you go. It's not state specific. It's kind of talking in general.
Yeah.
Because we're starting to see, houses staying in the market a little longer now, and we're starting to see more inventory come up.
Yep.
Yeah, so it's interesting because this is the time of year where normally inventory slows or kind of levels off, and then you have like this week over week incline, and they're by a little bit. It's like 1% or 1.5%, 2%. It's enough that it's worth talking about. But I think in the broader picture, the context is still that compared to just a couple of years ago, this is like half what we need. Yeah. And then I know we've been talking like normally in a healthy market, a 6-month inventory of housing supply is regular. That's normal, but we're like 3.3%. So that's hurting us. And in some parts, to your point about Redondo Beach, okay, some places have longer listing times. Here in San Diego, homes are not sitting for 60 days. They're like less than a month on the market, and they're in escrow, and then they're closing in, 12 days sometimes, 21 days in others, 30 in others, depends on the scenario. But they're not sticking around that long here in our backyard.
Yeah, I know. Yeah. If they're staying or sticking around for a little longer, what I've noticed is they'll have a big price reduction. And we're not talking about a $10,000. We're talking about like a $40,000, $50,000, right? Because now they want to, hey, what if we do like a auction on this, make it look like where people can now bid in this thing. So they'll just kind of use different tactics to hopefully re-stimulate the interest of a buyer to go in there.
Yeah.
So certain things, but
so in general, though, like the housing being at like this historical bottom is unhealthy. So no matter who you want to listen to, and you don't have to agree with us, the data's data. We're just reading the data off the charts and the actual recorded and reported numbers. So sorry. But here's the thing, like you can listen to lots of different people talk about this and have their opinion, but the truth is the numbers to the numbers, and we need more supply. We need more houses changing hands. And our year over year existing home sales are down this year compared to last and last year compared to the one prior. So, looking at 2024, I think we're probably going to be around where we're at still because life is still happening for people. And I think right now with so many people having golden handcuffs in the 2s or the 3s on their first, having a bunch of equity to use as their quote unquote ATM machine moving forward, I think we're going to look at a 2024. It looks a lot like right now.
Oh yeah.
Well, with selling the ADUs as condominiums, California is actually moving in the right direction for once.
Yeah,
we're looking good, guys.
There you go.
Good job, Gavin.
Yeah. What do you think, Brian? What's your opinion on inventory looking into the new year? We're coming into the end of 2023. What do you think?
So I'm gonna be a little optimistic on this one. I feel that in these winter months going into the November holiday season, whatnot, I feel that there's going to be deals for those that are looking for to get into a house. Why? Because maybe there's a seller that really needs to sell. Maybe there's people that really need to sell before the year's over, or they need to liquidate for holiday seasons, winter's coming, whatever it might be. I think that you could still find a good deal if you're have your numbers clearly ran and you understand that you should be buying when you can afford it, not when the market is down or up, because the market's always going to be down, it's always going to be up. But I feel like if you can afford the price right now and you could be resilient and weather out the storm, because like you guys just said, once rates come back down, what's going to happen? Flood the gates, prices go right back up or stay where they're at. So right now you can get in. Next year, it's a different story. You can't predict the future, what's going to happen, but at least you can predict what's happening right now in your immediate future. And if it makes sense, I think you're better off making that decision, because we've been seeing, I'm going to wait 2020 till the market crashes, 2021, 2022, 2023. We're into 2024, and I'm still don't seeing, the numbers aren't saying anything that it's going to crash. I mean,
And you know what's horrible about that? It's like, dang, 2018, I should have bought, but we're talking about that. That was the peak of the market at that time.
Yeah.
We thought.
And there was a lot of people in the fence like, dude, like this is, the market's going to peak. Like this is it. That was what we understood. And then COVID came. We're like, everything's going to crap.
Changed.
Everything's going to go to the bottom. It's going to go to 2008. And look what happened.
So,
oh my God.
Being that I literally just graduated high school in 2018. What was going on? And why do you say it was peaking back then? Can you tell me what was?
Well, I remember I came in, rates were on the uptrend because the first loan that I locked was at 5.250. And then from there into 19, they started kind of easing off a little bit. So I'm not sure. I wasn't even really aware what was happening with the Fed and everything at that time.
Well, part of what happened in 2018 is that we had come out of the glut of the housing collapse in 2008. And so when things kind of,
10 years later?
Well, hold on. They bottomed out. The whole collapse happened in 08-09, okay? Then they bottomed out, and then people really didn't start warming up to real estate till 11 and 12.
I could see that.
So we had this 5-6 year run where then prices were marching up through that time to 2018. It wasn't just an overnight thing, and it didn't start in 08. It's just 08 kind of led this. It was like a roller coaster. The price went way down, came back up, and then once people go, oh, I'm going to start buying again, 2013. You bought 13, right?
It was 13, so when it started. 2012 towards the end of it.
Yeah, and then so people started warming up, then they start doing it, and then now you're a couple of years in, 5 years into it, you've recovered, and 2018 is upon us, and people are saying we're at the top.
Some areas are still not having recovered from 2008. So it takes a long time. Remember we talked about earlier, when there's a new rule in place that comes into place, it doesn't have an makes an impactful decision right away. But it's a ripple effect. It takes time before that actually comes in.
Places like where? Like local? Like in San Diego or?
No, we're talking about just in general again. Yeah, just nationwide.
Yeah, in general, because there are also places where massive swaths of industry left. Yeah. So when there's a place where a massive factory shuts down, or and 50,000 jobs go away, or 100,000 jobs, I mean, and I can talk about Detroit a little bit only because I know cars and I like the auto industry,
and we love it.
There are parts of Detroit that have had to become revitalized because they were barren for a long time, and there's some parts that I see that I just from a distance can go, that's never coming back. There's not even buildings there anymore. So what's there to come back to?
Yeah,
someone
actually,
has to
I
go,
mean-
I'm going to invest in that and rebuild the place versus there's nothing there.
Yeah.
Even today, I
Rock and
mean, me and Brian went to Detroit earlier this year, and we only went up and down the block, but
But you get that feeling like, okay, from the ground up, this was built. It was torn down. 2018 came, but then Rocket just came in.
no,
And
yeah,
just did
like,
that.
and we would be in the bus on the way to the class, and like, I'd be at Brian, look, like, what the hell? Like, what's going on over there? Like, there's nothing here. Like, it looks like the apocalypse happened.
Yeah, there's
What is this? This is an East Lake.
Abandoned neighborhoods, abandoned cities, and abandoned industries.
Yeah, so I mean, when you say it like that, like it is real. I mean, we saw it firsthand not that long ago.
We're taking this information from Mikey when I took him on the 5 freeway past La Jolla.
No,
and
no,
there
no,
was
So what's your guys' favorite part of the show? All right, I'll tell you. Well, basically, there is a Mormon church over there that I had no idea existed.
Yep. Yeah. Mormon temple right off Nobel.
It's like a San Diego,
And this
They're like,
is
how long has that been there? And I'm like, really? You haven't gone out this far? And you've been living here
Been there a
since-
long time.
Hey, he doesn't go outside of the East Lake vicinity.
Yeah, that's all right. It's okay, Mike.
So-
Anything to look like an acolyte.
Next
a
week,
compilation.
next week after the show, guys, let's take Mikey to the beach.
There you go.
What? We got beaches here?
Never been in the sand before.
all right,
All right, guys. Well, let's go. We'll go home stretch, guys. So,
let's
what was
go.
your favorite part of the show today, Memo?
Yeah, my favorite part of the show is actually talking about the ADUs. I am such a fan of it. I am such a fan of bringing affordability, bringing inventory, just giving hope, right? It just gives us light at the end of the tunnel. So my biggest takeaway is thank you. Finally, we're starting to see some changes. 4 great laws have been passed, and I'm just so grateful for that. Now is just time to really learn them so that we can actually start implementing these things.
Awesome, Brian.
For me, it was having the opportunity to share with you guys my client success stories because I feel that if you call for that lifeline before you need the lifeline, you're going to be in a better situation. So, if you need to get ahead of the curve, definitely reach out to us. But there's solutions out there. All you have to do is get in contact with the right people and get guided to the land that you want to be at because honestly, you have the solution sitting inside your house.
Mikey.
So piggybacking off of Will's, my favorite was talking about the ADUs too for 3 reasons. One, it obviously solves affordable housing crisis a little bit. I mean, for example, like just using your ADU, for example, I feel like if someone saw it and for $350, they'd be like, wow, that's something very attainable for me. And it's nice too. So there's that. It's also more opportunity for our investors too to come in and build these and take advantage of it. And then the third reason is, I mean, I wasn't joking. It feels like California's moving in the right direction by passing these. So, I mean, it's very encouraging to see from someone just living here. I like to see that.
That's awesome.
Well,
Nice.
in the spirit of hybridization, I have a both and. I like both of our solutions and our ADU law change because it's for both sides of the housing situation. You have aspiring homeowners who are going to benefit from the ADUs being able to be purchased, and then you have the current solutions you have, Brian, for people in the market that already own a home, where they can actually leverage their house and their equity to actually advance their financial position. So on both counts, I was super happy that we started the show that way. I'm really pleased that we are all in agreement. Those are the best part of the show. I really think it was. And I'm really glad that we were able to talk about that today at length so we can give some people some solutions and some hope moving forward, not only for the rest of 2023, but for 2024. So with that, you guys, thank you for another great show.
Yeah, of course.
And for all you watching on YouTube, remember to subscribe to the channel, turn on notifications so you catch every episode right when it releases. And if you're listening on Apple and Google, make sure you have download every episode as it airs so that you hear about it first. Thanks for watching the Mortgage Heroes Weekly Podcast, and we will see you again next week.
And happy Halloween.
Yeah.